interest rates has been one of the latest topics because all this came before the Federal Reserve meeting on whether should they raise interest rate. And I think we talked about this over the last episode, like will the next interest rate rise be 50 basis point or 25 basis point? So what happened was that after all this situation, the basis points were raised by 25 instead of 50. And now, at the point of recording, we're at the tail end of March, a lot of people are predicting that the next Fed meeting, there's not going to be a rise in interest rates anymore. It's going to be a pivot situation. And of course, what's going to happen is that now, Fed Reserve in US is in, I would say, a very sticky situation. So what situation is this? Is that this quantitative tightening was meant to bring down inflation. And for Fed to come up with this monetary policy, basically in order to bring down inflation, they have to raise the interest rate in order to bring down inflation. But when they raised the interest rates over the entire 2022 till today, a lot of people are saying that this strategy has brought about too quick a quickening of the interest rates rise. And because of this, what is happening now is that this is affecting the banks in terms of the kind of bonds and treasuries that they're holding. And of course, that's exactly what happened to SVB. So maybe George, bring us through what happened with SVB.
So I think the key takeaway for SVB, just to give some context, they are the 16th largest bank in the United States. And that was shut down on March 10, 2023. So I think there's several factors that contributes to the meltdown. I think number one is because there was a lot of people that rushed in to withdraw the cash. Partially because it is being accelerated with the impact of the FTX, and then people start to withdraw the money from the banks. Secondly, it's also because I think what the banks are doing is with all the deposits that they have, they buy into long-term bonds.
Right.
So the impact of the long-term bonds is that when they buy into long-term bonds, just to again give some context, in Singapore last time when SIA was having a bit of market slowdown, they also introduced bonds, right, to open up to the market to raise some funds. So when bonds are being released, sometimes the interest rates are on the lower side, but they have to pledge in for a long period of time. And with the interest rates rising, some people want to withdraw the cash, and when they have to withdraw the cash, in order to meet the demands from the depositor, they have to sell away the bonds at a loss. So I think that, partially accelerated the happenings at SVB.
Right. To add on to Silicon Valley Bank, Silicon Valley Bank is a bank that has majority of its deposits that were being contributed by 30 over different accounts. And of course, a lot of these accounts were startups, tech startups, including Roblox, including a lot of the big names in the startup world. Yep. And what happened was that in 2020, when there was quantitative easing and interest rates were at an all-time low, the amount of deposits in the bank swelled to a very high level. And of course, as a bank, right now, in our fiat system, basically banks practice this thing called fractional reserve banking. And fractional reserve banking means that in terms of lending, you're allowed to loan out close to about 90% of what you have held in terms of deposit. So for example, if let's say somebody would place a deposit with me at $1,000, I'm allowed to loan out $900. So that's called fractional reserve banking. But what happened with SVB was that because they've collected so much deposits, they need to be able to earn interest off these deposits in order to pay the interest to their depositors. And SVB, compared to the big banks, in order to attract more people to deposit money with them, they have to give a higher interest rate to the depositors. And thus, they went into treasuries bonds. And over the last 2 years, basically, with the increase in interest rates, their treasury bonds decreased in value. And the whole bank run situation actually happened only through 1.5 days, because what happened was that there was news in the market that their treasury bonds were losing money. So they went out to the market to call for capital injection to raise $2 billion in order to cover the losses in their treasury bonds. And that news leaked to the market. So a lot of VC firms immediately overnight caught their startup to immediately withdraw all their money from the bank. And just in one day, $42 billion were withdrew from the bank. And that technically became a bank run situation. And the government has to step in And of course, through this stepping in, there was two learning points here, because by right, the FDIC, which is the government in US that is covering the insurance for the depositors, they only cover up to $250,000. But in order to prevent escalating bank run to other banks, they want to make whole for the entire sum. So the US government step in to say that they will cover the entire sum that the depositors have in the banking situation. Yeah. That, of course, to us is that the next question is that we want to understand, is this a stealth QE? Because is this like a stealth situation or quantitative easing?